Welcome to News You Can Use in your personal and professional lives. Hi, I'm Dan Finn, and I'm here to talk to you today about something that I believe is going to be very important to you as you plan for your future after your working days are over. Thank you for the opportunity to be of service to you today. Today's session is entitled De-risking Your Retirement Portfolio, How Fixed Indexed Annuities Can Help. I put this together for anybody who's thinking about how they can safely retire with the money that they've accumulated. To begin with, I want to talk about a concept called the safe withdrawal rate. The safe withdrawal rate is the rate at which you can withdraw an amount of money from whatever you've accumulated for your retirement and be able to make sure that that amount of money will last you the entirety of your life, or lives if it's for two people. Once upon a time, this withdrawal rate was set at 4%. Gradually, though, that number has fallen, so much so that lately one of the nation's foremost retirement researchers, Dr. Wade Pfau, suggests that the safe withdrawal rate now should be pegged at about 2.4%. Let's look at the S&P 500 over time. Let's take a snapshot from 2000 when the market was at 1560, and let's follow this for 13 years. Well, the first 2 years after 2000, if you were invested in the market dropped 50% in those 2 years. Market's now down to 800. It came back a couple years later. We're back up to 1575, but remember, a 100% gain is required to make up for what you lost when you only lose 50%. So you lose 50%, you need to gain 100% just to get back to where you started from. 2007, now the Great Recession hits. The market lost 60% of its value. It's now down to 680, and a few years later, though, it comes back at 150%, and it's now back to 1590 in 2013. So 13 years of time. An individual starts with $100,000. They lose 50% of it. They gain 100% of it back. They lose 50% of it. You're down to $40,000. You gain 150% of it back. So 13 years from start to finish, you begin with $100,000. You end with $100,000. Now, what if I told you there was an option instead that would allow you to participate in some of the market upswings when they occurred, so that if the market increased, let's say you'd get 50% of whatever the market earned. In exchange for capping your increase at 50%, you would never lose money if the market went down. Market drops, you lose nothing. Market goes up, you get up to 50% of whatever the market earns. If you had been in that kind of a product during this same time period, you would have started with 100, and because you don't lose money when the market goes down, 2 years later, you still have $100,000. Now you get 50% of whatever the market earns from that point forward if it goes up. So you get 50% on top of your 100,000, you're up to $100,000. So you're up to $150,000 rather. Now you lose 60%, or you don't lose it, the market does, but you don't lose 60%. You're down to nothing. You're at the same $150,000 that you were when you started in 2007. Now the market goes up 150%. You get half of that, so you're up to $262,000. By comparison, the one individual starts at 100, ends at $100,000. The one in the fixed indexed annuity, because of the unique features of that particular product, they are at $262,500. So they've earned about 162.5%. Let's take a look at this in a real world scenario. If those options had been available at the time, a 65-year-old male-female couple decides they want to set aside a portion of whatever retirement funds they've accumulated and want to make sure that they have a minimum $50,000 a year to last them for the rest of their life. This might be in addition to a pension, Social Security, anything that they might have, home equity, anything else that they might have that's going to sustain them. But they want to dedicate at least this portion to $50,000 a year for life. We're going to look at it two ways, one with the balanced investment portfolio and one with the fixed indexed annuity. assuming a 2.4% safe withdrawal rate, you need to start with a whopping $2,083,333 just to generate $50,000 a year for as long as these two individuals are expected to live. Now, that's not without risk. You have to understand that if this happened to coincide with the beginning of a bear market, let's say the Great Recession when that occurred, if the market went down 60% that first year, 50%, 40% even, all of a sudden that second year you're not able to take $50,000 out. So you need to adjust your lifestyle. Everything's going to change because you don't have the same options available to you that you did before. In addition to that, there's no guarantee that these funds are going to last their entire lives. They have these scenarios that these analyses that they can perform and run an infinite number of hypotheticals. And if you do that with assumptions about the markets going up and down and withdrawing at 2.4%, it would show that a statistically significant number of times, if those scenarios occur, that these individuals would run out of money before their life expectancies were up. So, by comparison, fixed indexed annuity, if you want to make sure you get $50,000 a year for life, you can do so, first of all, for almost half of what you can do with the balanced investment portfolio. And secondly, because of the structure of annuities, because of the pooling of the assets and the mortality risk that's shared amongst all the purchasers of annuities, you will never run out of money regardless of how long you live. You can live into the hundreds and you'd still have the money there. Most everybody that's watching this probably knows somebody or knows of somebody who lived into their 90s, maybe into their late 90s, and that's expected to increase over time. One of these options makes you not so happy, and even though $1 million is a lot of money to generate $50,000 for life, by comparison, it's a whole lot better than the first option. And that's it. I kept it short. If you have any questions, anything you'd like to discuss, please give me a call. Love to talk with you and see what I can do to help you make sound decisions about your financial future. Thank you for the opportunity to be of service to you, and I hope you have a terrific day. Thanks.